All right. Good afternoon, everybody. This is Glenn Wiggle with Independent Solutions, and thank you for joining us this afternoon. We appreciate it. This is an Independent Solutions Wealth Management Investment Committee discussion. We're just doing a market volatility update today with our investment committee. We thought it'd be good timing, of course, given the market volatility that's been quite extreme. Obviously, yesterday the market was down 1,100 points, and obviously there's a lot of concerns from clients as well as advisors out there. So wanted to get to our investment committee together, give us an opportunity, or you an opportunity to hear what their thoughts are on the market. As usual, Mike Lomas, our president of Independent Solutions, will be the moderator today. He'll be going around the horn asking questions of our investment committee. And then, of course, this will be available for rebroadcast, and I'll have a few final notes at the end. So with that, we're going to try to keep this to 30 minutes today. But Mike, you have the floor.
Perfect. I'm going to start out with John Thur, one of our chartered financial analysts. And John, the big question, the question everybody's asking is, where do we find a bottom? And I know there's no light switch or no bullhorn that says here's the bottom, but of course that's the question everybody wants to know. Where's the bottom to this thing? There's been lots of stocks that have been hammered, specifically the growth stocks and the NASDAQ, and just a lot of damage in some of those more growth oriented companies. When is this thing end?
Thanks, Mike. Hi, everyone. I know that's the big question everybody's trying to get answered here. And I don't think there's going to be a clear bottom. I think that this is going to drag out for a while. And I think we're going to hit a level, and I want to say 33 to 3,600 on the S&P, and then we're going to move sideways. And I think it could take 12 to 18 months of sideways movement to digest everything that's going on. And that sideways movement could be from that 33 to 3,600 range to the 4,200 range. So it's going to be a broad range. And I think there's going to be an ability to make money, but you're going to have to make sure you're in the right positions in order to take advantage. I think some of the key points that lead me to believe this are, I think inflation is going to be worse than everybody thinks. And I think we could potentially hit double digits. I think food and energy are the two worst components right now. I think the war is going to drag out. I think energy policies are not going to change that much. I see margin compression starting, and I think that's going to get worse. And the big thing is the M2 money supply that has grown over the last 18 months to 2 years, especially. I'm not even counting what happened the last 10, but just count the last 18 months. And now the velocity of that money out there is increasing dramatically. Mm-hmm. So this inflation monster has gotten out of control. The key component there is going to be how slow or how fast the Fed acts. And if they go too slowly, that's what's going to make this thing drag out. If they go quickly and kill that inflation, as fast as they can, and maybe overshoot and then pull back, we'll have a quicker recovery. I think either way, there's a recession. If they go quicker, the recession will be less damning. So that's what I'll be watching. What you're seeing in the markets right now is basically a de-risking. And by that, I mean, in a premium taken out. We've had a premium because of low interest rates. Now that premium has to come out because interest rates are a headwind. Mm-hmm. I think the premium's been about 30%. I'm not saying we have to go down 30%, but NASDAQ's almost there. And that's where a lot of the premium was. And I think that what you're seeing is the first wave of stocks to get hit are the no income, no dividend stocks. They are the longest duration. And then you got the income, but no dividend stocks. Now you're seeing the stocks that have income and dividends getting hit. And a lot of that is the deleveraging and the forced margin calls. And it's the good goes out with the bad. So we're getting close in stages to hitting a bottom. We need to see more days like yesterday, maybe a couple days down, a couple thousand, would be on the Dow like we had in 2020 would be a capitulation, which I'd like to see a little more volatility over 40, but we're not there yet. I think the key here is like I said, I think this is going to drag out longer than people think because it is so complicated. And I think we're getting near the bottom, but we're going to be sideways moving for quite a while. There isn't going to be a V-shaped recovery like we had in March of 2020, but a lot of stocks are getting attractive, and I'm getting very interested. This is a positive in my book, because the universe of stocks is opening so much greater to managers to be able to buy and not feel like you're paying up for them.
John, you said Goldman Sachs actually estimated that there's about a 38% chance of the U.S. economy entering a recession. Do you think we're in a recession right now? I mean, we had, the economy contracted last quarter. To me, I am seeing, things like houses still on the market, which is crazy to say because a year ago there was no such thing as a house on the market. In fact, Peter, I think, sent us a funny clip about a house falling into the ocean and just joking around saying, he just closed on his new piece of property. But, are we in a recession now?
It depends how you define recession, Mike. But if you're asking me, are we pulling back from the rapid pace of growth? Yes. Are we going negative? I don't think we're going negative yet. And what I'm saying is because of the magnitude of the trillions that were dumped into the market over 18 months, and now the velocity of which that money's turning over. And then to get more detailed, you could talk about the reserves at the Fed. They're way over reserves. So banks, let's say the Fed wants to raise rates to cut demand and cut lending, get banks more in line, not lend as much and get the velocity down. Well, the banks have so much excess reserves, the Fed can't control that unless they start to pay them more to keep the reserves at the Fed. So this goes deeper and deeper layers. But all I'm saying is that we're definitely going to see a slowdown. And if the Fed acts too slowly to curb rapidly rising inflation, this could drag out longer, and then the recession will be worse. We could have a quick recession of, hey, Fed went to 3.5, 4 on Fed funds. They've really clamped down. Now they're pulling back to 3. Okay, the recession will be lower. It'll still be a recession, but we'll have more control over the length of it and the magnitude of it. But right now, I'm not down on the economy at all because the demand is so great. And if the Fed moves slowly, we're going to move towards stagflation, which is the worst case scenario because that drags out and it hurts everybody. And I'm more concerned about margins and earnings because you start to see Walmart and Target yesterday were huge clues as to what's really going on out there. The consumer's changing its patterns and how they buy. It's starting to feel it. And I think that's where this is going to be. We're just at the beginning stages of this. So
we're in the beginning stages of it. Should I just sell everything and just go away?
No, I think bonds are going to start to become competitive as rates rise and the bond yields rise. I think bonds are going to start to be competitive. You saw the first signs yesterday when people got concerned with not only Walmart, but then Target coming out and they're saying, whoa, maybe the recession's starting. Maybe like I'm talking about, we're getting in the beginnings of this thing. Maybe we need to sell some stock and buy some bonds. You had a flight to quality a little bit, which we haven't really seen yet. Typically when stocks get hit, money moves to bonds. We haven't seen that yet till yesterday. You start to see the bonds act better. So I think as rates rise, they will start to be a competitor to the stock market, which will get lower estimated average annual returns for the stock market. You'll start to see some more balance, some more options than just stocks. But the quality stocks will hold in there and they will not get hurt as bad as the rest. And then the money that goes into stocks will cram more down into the lower risk stocks. So there will be a component in the market that you can hang into, but there will also start to be the ability to have competition and own some bonds again. Perfect.
Let's switch to Paul Meeks here. Mr. Meeks, known as a tech investor, although managing multiple portfolios for us. Some of the, as John was alluding to, some of the stocks that have been hit the hardest are the more growth-oriented tech types of stocks. Where are you with this overall? With your portfolio, what do you specifically are you doing? Are you buying some of these stocks, or are they a falling knife where we're going to get hurt? Where are you?
So if I was to fund a brand new tech portfolio today, right, clean sheet of paper, I first of all wouldn't invest it completely. I'd try to go in slowly and deliberately, and knowing that it's impossible to time the market, but I still wouldn't put 100% of capital in. And I do think with the tech names in particular, we're going to have a new regime. And when I say a regime, that means I think it's going to last for a period of time. It won't be short-lived, in which back into favor within that particular sector are companies that have real sales growth, real earnings, and real cash flows. If they are too levered to a simply growth at the expense of profits, then I think we're going to be in some trouble. So some of those darlings from yesteryear, the ones that were propelled by zero interest rates, even if they have, pretty good growth prospects, I still think their valuations can come in quite a bit. So I'd avoid them, and I'd go to some, I know it's sounds a little funny to say it, but more defensive names. And as I have always said, I would keep for everybody, except if you're super aggressive, technology should be just a portion of your portfolio, right?
Yeah.
You shouldn't be loaded to the gills with tech and aggressive growth stocks in almost any environment, particularly not now.
Yeah. With your existing portfolio, with anything, are you a buyer right now, or are you holding off? Where are you as far as positioning goes? Do you think
So with existing
reverse?
portfolios, I am buying some, but I'm shuffling the deck, right?
Okay.
Companies that are much more valuation sensitive, that can thrive in an environment where inflation and interest rates are rising, at least for now. And they're still, regardless of what's going on in the world and what's going on in their businesses, can grow their earnings per share this year and next year.
Mhm. Are there valuations out there that you say I gotta buy? I mean, there's some stocks that just seem to be crushed, and you were talking, I think it was on CNBC about was it AT&T, where we're at 7 times next year's earnings? I mean, when does it get so cheap that you gotta say I have to have this stuff? I mean,
there's some stocks, particularly in industries within the sector, that did not get egregiously priced, at least not the most of them. There's companies in semiconductors, for example, which I think meet that criterion. Companies like Advanced Micro Devices and Micron that I think are buys today. I also think there are some, I call them techish. I don't even think they're tech names. And I do have on my list IBM and AT&T, which I've hated for most of my career, but I like them now as relatively defensive plays because they do have some semblance of growth, and they do have dividend yields today that are 3, 4, 5, 6% in some cases.
yeah. Paul, when you look at the problem in regards to inflation, part of it has been inventory. They look at houses and there's just not enough inventory. We haven't been building enough homes. And part of that is the Fed is trying to control the price of homes with increasing interest rates. But the other problem we've had is inventory when it comes to things like automobiles. And specifically, we've talked about the chip crisis. Do you see any of that stuff clearing itself up? I heard somebody the other day say, well, we're going to have this glut of cars because all of a sudden we're going to get all these chips we need, and we'll be able to plug in the 2021 cars that are still sitting on the lot. And is there any truth to that?
I don't think there's truth to that. From what I can tell from the semiconductor companies I follow, and they've just given us a set of fresh data with their most recent quarterly reports, which all went down just in the last couple of weeks, is that the supply chain crunch in semiconductors, not for every chip, but for typically the chips that go into industrial applications like the automobile, they are going to be in short supply, I think, well into 2023. So I see some relief because it's been so extremely bad, but not much.
Okay. So I would call you a patient buyer. You're trading up, trying to get the good names that you like at a better price, and just holding tight.
Yeah, that's right. And taking a look at tech stocks differently than I did before. And yes, there are going to be opportunities. And if somebody is truly a long-term investor, this I do think is a decent time. The problem is everybody says they're a long-term investor and then they regret that the next minute. But if you truly are a long-term investor, as you should be, I do think it's a decent time to buy tech. You don't have to, funnel it all in and be 100% invested in a single day, but not too bad to scale in right now, but with a different breed of tech than was popular the last few years.
Gotcha. Switching to Danny Neiman real quick. Danny, being part of or head of our investment committee and team, you focus a lot on, overall portfolio models. I mean, you manage a value portfolio, but looking at some of the overall models, I wanted to ask you about rebalancing. Have any of the models triggered a rebalance, meaning that stuff is, keep it simple, stocks go down, sometimes bonds go up, and our rebalancing, although we're not a timing firm, if you look back at when you guys have rebalanced our models over the last 10 and 15 and 20 years, it's just been accidental good timing, meaning, hey, the stock market's cheap, the bond market's up a little bit. Have any of the indicators triggered a rebalance for us?
Yeah, sure. And thanks again. Thanks everyone for joining. Obviously, the great input by John and Paul. When it comes to our overall portfolios, the core allocation strategies, both the ETFs and mutual fund strategic allocation portfolios, we are in the middle of doing rebalances. I believe our ETF portfolios were rebalanced this past week, and our mutual funds will be rebalanced over the next week. Some of the things we're doing inside the portfolios too, John alluded to, a lot of people are de-risking their portfolios. We haven't changed our allocations a ton, but we have decided to increase the value portion of our portfolios and slightly decrease the growth. And I'm talking by just 1 or 2 percentage points. We've also gone ahead and lowered duration a little bit from our fixed income side to keep the same mix, but again, buy down on the market. So I didn't want to sell our value names and buy into growth at the time as we're rebalancing, rather keep value where it's at and potentially buy into some of the other areas inside of our portfolios. I think doing a timely rebalance, not necessarily timing the market, but timely rebalancing, meaning we're going to go ahead and average cost into some of our holdings at this time, is a good way for, take the opportunity, as Paul mentioned, and buy low. We can't really predict when growth is going to come back, but what we can look and say, I can look at most of the stocks that I'm buying in my value portfolio, dividend stocks, and say, you know what, a year ago I was buying these and now they're even lower and even cheaper. And while some companies may not make it through a recession, a lot of the big names will. You look at what happened yesterday with Target and Home Depot and earnings and what they're predicting going forward. And you look at what happened with a stock like Costco over the past few weeks, now getting, kind of getting crushed down 20% year to date. I see some of those stocks as buying opportunities. I don't see people not shopping at a place like Target or Costco over the next year, even if the dollars are squeezed because of a recession. I see people actually loading up at places like that and maybe not buying at Nordstrom's or not buying airplane flights and traveling, but they need their essential goods. And where do they buy those things? Amazon, Costco, Target, those places are going to continue to thrive. Will earnings be lower potentially? Yes, but will they be here 5-10 years from now? I think so. And I think stock prices will eventually go higher. So I'm just trying to take opportunities where they lie, like Paul mentioned, and pick off some good names here at cheaper prices and hope that the market at some point turns around and we get through the combination of messes that we're in when it comes to both inflation, the war in Ukraine, interest rates rising, all the things that we're going to talk about and we've talked about for now 6 months. So I think the best idea from a retail rep standpoint is have your client stay the course. Don't go switching models, just chasing what's happening. If your client is a risk averse, stay in risky portfolios. If your client is a conservative person, stay in your conservative portfolios and let us do our job from a portfolio management standpoint. Try to read the tea leaves of what's happening in the market.
Perfect. Mr. Nielsen, Peter, it's an uncertain environment. I know you do a lot of fundamental analysis, and how do you view financial fundamentals today?
Ironically, you wouldn't guess that they're good, given the market volatility we're seeing. But at this point in earnings season, we've seen about 450 S&P 500 companies report. Average sales surprise has been about 3%. Average EPS surprise has been about 9%, which reflects better than expected margins.
You wouldn't think that, right? With all the negativity that's out there.
Well, I think that highlights how much animal spirits are playing a role in the markets today. So yesterday we had, well, Wednesday evening, sorry, Tuesday evening, Wednesday, we had Walmart report Tuesday evening, Target report Wednesday morning, and they both missed badly because of higher than expected costs and lower margins. And instead of seeing consumer discretionary stocks trade off, we saw the entire market trade down. So that tells you the kind of market we're in. The market reacts broadly to bad news. So yeah, what we're seeing right now is better than expected margins. Now, in our quarterly report, we did say that we expect margin compression, a little bit of margin compression this year. You have to realize that not every company is experiencing margin compression. Some companies are benefiting. I think it was Nike that said that, yeah, we got higher input costs, but we're comfortable that all our price increases will easily offset that. And the same thing with Caterpillar, which is probably one of the most cyclical firms out there. So there are some firms that have been pretty proactive as far as pushing through price increases, and they're comfortable that they're going to be able to defend their margins.
Are you seeing companies concerned about supply chain disruptions still, or is there any kind of quote, we're going back to a little bit of normal?
Okay, basically every firm is concerned about supply chain disruptions. I mean, Apple, they noted that supply chain disruptions cost them about $6 billion in sales. But I'm seeing a lot of companies report that supply chain disruptions aren't as bad as they were. So like Boston Scientific, they're a healthcare devices company. And what they said is say, look, we really think things are getting better, but we just don't have enough clarity to improve our guidance. So we're going to stick with the status quo. So we're seeing lots of stuff like that. Eaton Corp, they said there could be a lot of upside in the back half of the year, but it's just prudent at this point not to change our financial guidance or assumptions. So the basic theme I think that I see is that companies are saying supply chain issues are getting better, but they're still there. So as Paul indicated, we're still going to see a chip shortage for an extended period of time. It just isn't as bad as it was.
Mm-hmm. When do you think inflation will quote normalize?
Yeah, well, I mean that's a thing. I mean, how do you take inflation out of the system? And the Fed knows they have to hike rates to do that. So, but there's a tension between how easy or hard that's going to be. So here are some of the signs that inflation is trending lower. Well, number one, it already is. Remember, March inflation was 8.5, 8.6%, and it declined to 8.4% in April. The issue was economists expected it to go to 8.1. So it's declining, but not as fast. And I think that kind of epitomizes our current situation. We may have to see a few CPI prints, trend lower before I think the market gets comfortable with inflation declining. But, some signs that inflation might decline. New COVID infections in China have been seeing a drastic drop. And even more important is that COVID deaths in China are dropping even faster. So I think Pfizer, they opened a production factory to produce their COVID antiviral therapy there. And I think that's probably a watershed moment for China. I mean, in other words, they can reopen, even they don't have to necessarily adopt a COVID zero strategy. They can reopen and have a therapy that they can distribute to their people. Yep. Another thing is core goods CPI actually fell 0.4% month over month in April. Inflation expectations, I think most importantly, as measured by the 5-year Treasury tips break even, they've declined from a peak of about 3.7% in late March to 3.3% today. And that's critical. because if inflation expectations start spiraling out of control, that's when we have problems. That's when we have like cost competitiveness to attract employees and that sort of thing. So inflation expectations are actually on the decline, and I think that's something we can take heart on. I mean, there's other things we can point to, like the Manheim Used Car Index and other things, but in general, I'd say inflation indicators suggest inflation will decline.
Everybody, focuses, because you can't sort of get away from it, on the Dow Jones, the NASDAQ, the S&P 500. You run an international portfolio. What is that telling us?
Well, okay, so international stocks got beaten up a little harder than other stocks during the downturn. And right now they're coming back a little harder too. So I mentioned a while back how certain companies it seemed like the closer you were in the proximity to the Russia-Ukraine conflict, the harder your valuation levels got hit. So I'm looking at some European banks right now, and they are priced at levels that are basically below what we saw during the global financial crisis.
Wow.
Yeah. So we're talking banks who have stronger balance sheets than they had back during the global financial crisis, and hopefully improving earnings prospects, but and on a price to book basis, lower than what we saw in 12, 14 years.
Yeah. Well, so what action would you recommend to investors with our financial professionals that are on the phone right now?
Well, like Paul and Dan indicated, look, if you're in a strategy, stick with your strategy. The chances of you being able to time it right is remote. One thing we did is we took a look at how style investing differs during this market downturn in daily return numbers year to date. And so if you're a growth investor, obviously you're getting hammered. But the positive return days actually are larger than the sensitivity to down markets. So if I'm looking at the weekly return for the NASDAQ 100, the weekly return to Wednesday for the S&P 500 is down 0.3%. For the NASDAQ, it's up 0.5%. So yes, growth stocks sell off harder during days when the market's down, but they also rise a lot higher than the average market when the market rises, at least over the last 4 months. Mm-hmm. So I would say, look, stick with your allocation. I am seeing some of the growth stocks that their fundamentals don't seem as appealing as they once did. So what is it? What's the old saying? Buffett once said, when the tide goes out, we find out who's swimming naked. Mm-hmm. Some of the stocks, they don't look so hot on the basis of fundamentals. So, the stories just aren't as compelling. And, when that happens, make a change. But aside from that, stick with your knitting. If you're in growth, stay with it. Now, if you're deploying new money, as Paul said, you might want to reconsider, because the dynamic is, I think, going to be a little different for the next 10 years than we've seen the last 10.
Yeah, it always seems like when we have these bigger shifts that not the old winners aren't always the new winners. You got to be careful. So, well, I thank each and every one of you for your input, and I'm going to hand it back to Mr. Glenn Wiggle to wrap things up. I will just say, folks, all of our money managers, we're available. If you have concerns, if you're in some of these portfolios and you want to really a more in-depth discussion on what's going on, reach out to us at any point in time. We're here to help. With that, I'll hand it back over to Mr. Wiggle.
Thanks, Mike. And thanks to all of our panelists today and everyone that joined us. I appreciate it. Just a couple of last comments. If you would like to get on a call with one of our money managers or get on a call with a client and one of the managers, we do have a new request form to make it easier for you. So you can go to our website at iswealthmanagement.com. There is a advisor portal. The password is simply solutions. and you'll find the form right there. Of course, you could always feel free to give us a call directly at the office as well at 716-633-1515. I also want to mention that we still have our top producers contest first period open till the end of May. Sometimes these choppy markets, although painful for existing clients, present terrific prospecting opportunities. And so up until May 31st will be $2.5 million qualifies you. The next period number 2 will open, of course, the next day on June 1st, runs to the end of October. So $2.5 million throughout that period will get you qualified. Again, for more information, go to our website at iswealthmanagement.com. And finally, we'll be doing sort of a replay of this, our normal economics and markets update that will be open to clients will be in just a few weeks. So keep an eye out on your emails for that. You're welcome to invite any of your clients or prospects to that call that is open to the public. So thank you again for joining us today. We really do appreciate it. And I hope you have a terrific afternoon. Thanks.